please remember that these training webinars are not a solicitation nor a recommendation, but simply educational in nature. The presentation is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the NinjaTrader brokerage directly at the following phone number or at the following email address.
All right, good morning everybody. Thank you, Anita. That was my pregnant pause. No, I didn't turn the mic on. I see some familiar faces from Australia, so good morning and thank you for getting up super early, and of course plenty of new ones. So thank you everyone for attending. Now, just before we begin, just please spend a moment reading the disclaimer. And just a quick background. So a little bit about me. You're welcome to read through the details there that you see on the screen. I've been in the industry for a long time now, and it was when I was managing money for wholesale clients over a decade ago now that I commenced using NinjaTrader back with, I think it was version 6. So NinjaTrader was really what paved the way for me to commence short-term intraday trading. However, it's my experience from trading across numerous asset classes, managing funds, trading interest rate products for a proprietary trading firm, and I think most importantly, exposure to great traders that I'm going to bring you today's topic. And that is providing liquidity to urgent exiting traders. So what does that even mean? Providing liquidity to traders on the wrong side of the market is a legitimate business a retail trader can successfully participate in. I underlined and bolded retail because most of the institutional trading is non-directional. So what I mean by that is, where as retail traders, mostly we're looking to buy an instrument and benefit from price moving up if we're long. For non-directional trades, they'll typically have numerous components to the trade across numerous and various assets. So today is specifically about prospering as retail traders. Okay, so I'm just going to take a step back in time to a film, the Trading Places. Does everybody remember that movie, Trading Places, with Dan Aykroyd and Eddie Murphy? I'll just give you a quick refresher, and for those that haven't seen it, you'll soon be able to follow along. But this has got some important points that will follow on, and we can use to actually benefit from trading as retail traders. So, as a quick refresher, Dan Aykroyd and Eddie Murphy, the film's protagonists, uncover a plot by their nemesis, the Duke brothers, to use a leaked report about the health of Florida's orange crop to game the frozen orange juice market before the official crop report is released to the public. But the protagonists swap the real report with a phony one that claims the crops have been badly damaged, a fact that would, if true, cause the price of frozen orange juice to skyrocket. When the stock market opens, the Dukes, thinking they have key insider information in the form of the leaked report, aggressively buy the OJ futures before the crop report comes out, which would inflate prices of the futures. That then prompts everyone else on the trading floor to do the same. A frenzy takes place. Buyers chase buyers, driving up price. Now try to imagine what that looks like. The frenzy, the can't miss out, must buy, must buy. Aykroyd and Murphy play along at first, buying up frozen OJ futures of their own. But when the price peaks, They dump everything they've got on the other traders who are still hungry for all of those OJ futures to get their hands on. Once the real crop report comes out, proving the oranges are fine, which the value of frozen OJ futures to crater, they then buy back those assets. Now what happens to price? A free fall, yeah? Everyone's been driving it up and then suddenly find out that the thing's overinflated. Imagine all those traders long, the ones who bought and bought on the way up, and then suddenly finding that they're on the wrong side of the market. So if we look at this slide here, when traders find themselves on the wrong side of the market, and in the background I've actually got a scene from the film, that's the frenzy taking place. At a specific moment in time, an imbalance between the number of buyers versus sellers at specific prices trying to do business is created, forcing urgent traders to accept worse and worse prices. As those worse and worse prices are transacted, that's price movement. This is emotional fueled price movement. Now, a trader holding inventory provides a service to urgent to exit traders by providing liquidity. If you're thinking, hang on a minute, what about the Forex markets that I know many of you trade? That market's huge. How can there be liquidity issues? And that's a reasonable assessment. With the retail FX market, the product traded is generally an OTC product, or over the counter, not an exchange listed product. The pricing comes from liquidity providers who compete amongst each other to win business. And their yardstick for fair quotes is the underlying futures markets. If they dare deviate too much from underlying markets or their competition, arbitrage traders, financially speaking, will skin them alive. If you trade over-the-counter products, CFDs, that type of product, etc., you are best using the underlying product as your yardstick. By this I mean really understanding what causes price movement in the futures or the stock or whatever it is, because it will be duplicated in the OTC, over-the-counter CFD type product. I want to show an example of this in electronic markets in the Australian dollar. On the screen is the depth of market. We can see all of the prices, five levels deep for both the buyers and the sellers. All right, so we've got numbers of contracts that are sitting here on the bid for each price point, and then also here what the number of contracts that sellers are offering at the offer here on the right hand side. Now we also have volume profile. So for those of you who aren't familiar with volume profile, that's these horizontal lines, and just a quick explanation, what they are displaying is for each price point there's X number of contracts that are traded. So the best way to think of it is the fatter, or the area of the profile, that's where more people are trading, more contracts are being exchanged, and in the very narrow areas, that's where very little business is being done. So the fatter the profile, the more volume that has been traded at that specific price. Now notice that the large fat area near the bottom of the profile, that's our highest agreement area for the previous day, meaning lots of buyers and sellers agreed to do business right at that price. And now notice how so far today agreement is actually at a higher level than the previous day, meaning that the majority of traders are actually agreeing to do business at higher levels than the previous day. So quick question, do you think as a trader it's helpful to know where traders do and don't want to do business? Right, so I'm going to start playing forward this market, and what I want you to keep an eye on is the profile. So we already know today that traders are agreeing to higher prices than yesterday. All right, so I'm just playing this forward. Just keep an eye on how the profile is changing. Did you notice the change in the profile then? So traders are showing that they are prepared to pay higher and higher prices. There's something else here I want to make note of. Imagine the other traders who just sat through, all right, so this period just here, if you have a look at the time, that's actually an hour of price movement, or lack of price movement really. So have a think about this. Traders who've just sat through an hour and a half actually of price not going anywhere, what are they likely to do? Have a think about what traders, even yourself, would be thinking that price has been going up and now for an hour and a half it's been going nowhere. The longer the price spends not going up, the more sellers will be enticed to enter short positions. So we have a whole lot of new sellers in the market. Does that make sense? Before I move forward, see the sell orders in the actual market? That's all of the contracts for sale in the order book for each of those prices at this actual moment in time. What will happen if you have a buy stop order, let's say at this price here, where there's 97 contracts available, but the trader in the queue before you actually has an order exactly for that amount? All right, so let's keep moving forward. All right, so a couple of things. Obviously price spiked. Now, does everybody know the show Mythbusters? So check out the profile on the right hand side. Not much business was done during that move up. Can everyone see that? Right? Hardly any business was done in this area. So one of the biggest myths is that when price moves, it's due to lots of volume. So is everyone understanding now how imbalances between buyers and sellers move price? Because this is really the key concept that what a successful retail trader's approach to the markets revolves around. All right, so moving on. Like in poker, there is only one pot of funds, and everyone who enters a trade puts funds into that pot. Yeah, we all agree? So how do traders keep taking the pot? By enticing traders to go one direction so they can go the other. Now I mentioned a fictitious version of that with trading places. All right, so they had a funky report about the outcome of what was likely to happen to oranges, and they were then bought up so that then once the real report was released, the price could be driven down. All right, so that's what I'm referring to about getting traders to go one direction versus the other. Now, we don't all have to do this via insider information, of course. So just to recap, what we have seen and discussed thus far is losing traders are urgent traders. And when you put a whole lot of urgent traders together, you get price movement. Price moves in the direction that hurts the most people. If there was one thing to take away from today, it would be this. But of course, no one enters a position volunteering to get hurt, yet the market, as we have already demonstrated, forces traders to exit. So if we want to provide liquidity to those exiting losing traders, we want to know how the market does this. Yeah? Everyone agree with that? So to avoid honing in on every individual bar, we can filter our data by using a moving average to get an indication of what's happening. And in this case, we can conclude with this chart that there is a directional skew to the upside. So I'm sure everyone agrees with that. But what if we just focus on this area in here? So we've got a move overall that is to the upside, yet there's a great period of time when price is failing to move higher. So just imagine if you were long in this market and then you were sitting through this period. What would you be inclined to do? What do you think traders on the sidelines would be inclined to do? What's happening here is short traders are being enticed into the market because they become myopic in their view and lose sight of the bigger picture. And as we have seen, there is then an imbalance which causes rapid emotion-fueled price movement. Okay, so I've taken exactly the same chart and now overlaid the volume profile. Each one of these bars lasts for 30 minutes. And what we can see is that this period here, where price was, in inverted commas, no longer going up, as we discussed, enticed lots of traders to enter short. When you've got a whole lot of traders wanting to urgently exit all at the same time, you get this rapid price movement. And what you can see in the profile is there is actually not that much business done through this period. This is where all the trading was conducted. Same back here. But when price really started to rocket, there wasn't actually a lot of contracts traded. So essentially what I'm saying is price was moving, but it was pretty thin as all of the stop orders were spread out across many different price points. So however, due to the misconception among many traders that strong price movement is always correlated to high levels of volume, traders get sucked into chasing the markets, getting in at the highest points. Now who's done that? Seeing a market move really aggressively, thinking it's going to continue, and then you jump in, and as if it's almost perfect timing, the market then goes the other way. So the reason we trade with the directional skew is because those who fight it actually fuel its continuation. Now remember that saying, the trend is your friend. I actually never knew what that really meant. But when you think of the market in terms of agreement, lack of agreement, and also traders being enticed into taking trades in the wrong direction, you can understand now from that view before how it's actually those traders fighting the move, unbeknownst to them, that they're actually fueling its continuation. So we know that buying and selling fuels the markets. Speed of moves, size of moves, duration of moves all tell the story of the relationship between buying and selling that's taking place. The speed at which the market transacts business influences price movement, as we've seen. We know this. We see that when price is moving really, really slowly, the natural reaction is to think that the move is over. When the market's moving really, really quickly, we're enticed to act. It's a bit like moths to a naked flame. The using up of buying and selling fuel tends to be a tricky concept, so I'm going to break it down and move through some examples. So let's assume we've already deduced the market skew is down. Now, because traders fight the directional skew, and therefore fueling its continuation, we want to be a seller. Everyone agrees with that. So before we enter our sell position, we want to see evidence of what? Prior to entering our short, we want to see evidence of buying taking place, because those buyers will fuel the continuation of the move down. All right, so here we've got a couple of examples of markets going down overall. So both of these examples, left and right, there's a directional skew to the downside. But recently buyers have stepped in because, well, prices moved up. We can see that. So if I was to give you a choice between the left or the right sell trade, which one would you take? And I'll give you a clue. It's the one which has the most buyers in the market as of right now. All right, so has everyone picked either the left or the right? So let's have a look at this on the left-hand side. We can see buyers have come in, but then some selling's taken place. Then some buying's come in, selling, buying, selling, buying, selling. And then we look at the right-hand side. By contrast, it's buying, 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 buying all the way up. So out of those two versions, which one has got more potential trapped fuel to continue the move to the downside? So the answer is the right-hand side. Does everyone understand that now? All right, here is something different. Would this be a sell? And if so, why? I'll also give you a clue. We actually went over this a few slides ago. Now, while you're having a think about that, I'll just mention that I know there's questions and things coming in, but what I'll do is just if you can save them, and I'll go through those at the end, because I'm sure that one or two questions will be perhaps answered along the way, and also others will probably have similar questions as well. All right, so in this scenario, we've already discussed this. We've got price been moving down overall to the downside, and then it's no longer going down. So this is a classic sell because of the amount of time that's passed in which buyers are enticed to enter. Now, I call this the bread and butter trade. If you're familiar with the term, you know, what's the bread and butter in your business, etc. This is the stock standard trade that, whether it be to the upside or the downside, that I focus on the majority of my profits. Okay, so let's take some trades to try to incorporate some of these concepts. All right, so we've got a market here. This is the Aussie dollar futures. What I'm going to do is I'm going to swap between a few slides, and what we'll actually go over and see what points of evidence we can come up with to for it either being a buy or a sell. So let's look at the reasons to sell this. Well, we talked about the directional skew overall. So it's to the downside, and we know that we want to trade with that skew because those who fight it will fuel its continuation. We've also got decreasing value over several days. So you can see where traders, even without looking at the price bars, just purely looking at the profile, we can see that buyers and sellers mostly are agreeing to lower and lower prices. We've also got potentially multiple failed attempts by buyers to push the market higher. So what do I mean by that? So if we look just in this area in here, we can see that buyers have on numerous occasions failed to push that market up. All right, so that's multiple times that buyers have stepped in but failed to push the market up. So that's like a safety in numbers thing. You're seeing continuously that that other participants, the buyers in this case, are unable to push that market up. There's something else as well, and this comes into volume profile and some of the concepts which I'm not going to have time to cover, but what you see in auctions, and this doesn't matter whether it's auctions for art, auctions for property, or even the financial markets, when price moves to a level of agreement, all right, think of a house auction, bidders bidding up the price. When it gets to a level that price the seller's happy with, auction, that's it, that's the end. So you often see with the volume profile, if you're thinking of it in terms of an auction and agreement, the once price moves up to an agreement area and everyone does their business, then there's no reason for price to keep moving. You can often see price move actually in the counter direction. So we've also got failed attempts that I mentioned and price moving away potentially from high agreement. But let's look at the other side of the coin as well. What about reasons to buy it? So can you see in this market clearly there's been many times when price, when it's moved down quickly, there's been a lack of agreement for it to continue and it's just spiked back up again. All right, so that's a valid reason to buy it. But overall, we've got many more reasons to sell than to buy. So I'm going to stick with the sell side. All right, so I'm going to play the market forward as we work through a trade. All right, so that now confirms that we've got our multiple failed attempts by buyers and the price moving up to agreement, and we've seen the market now roll over. So now we can enter some orders. So risk, where's a sensible spot to put that? Well, if our trade is based on all of these failed attempts to move higher, then somewhere around here would be a pretty straightforward place to put the risk. The entry. Now we've just had some aggressive selling, and if we think about fuel consumption, if we've just dropped like that, we would have used up quite a bit of selling fuel in the very, very short term. So the likely outcome from here is we might get a little bit of buying to come in. So we can probably benefit from buying at a slightly better price. So rather than entering here when all the selling fuel's been used up in the short term, we're likely to be able to benefit from an order placed a little bit higher up. And our target, well, I'm going to actually get to targets a little bit later. So for now, I'm just going to pick the jackpot, you know, maybe pop it down here somewhere, kind of You know, that's like the lottery ticket, sorry. All right, so moving on. So this is what our orders look like if they're on the chart. All right, our entry, risk level, and as I said, I'm just popping a target in for a best case scenario. I'd be pretty thrilled if price moved to this level. All right, so let's play the market forward. All right, so there's that buying coming in because all of the selling fuel was initially in the short term used up, so we get filled. All right, so now we're in the market. We'll continue playing the market forward. All right, so now price has quickly moved our way. So have a think, what's good about this trade other than it's working? What's good about this trade is that we now have a cushion. All right, so it hasn't reached our target, but we can take off our risk or tighten our risk up and enjoy a relatively risk-free trade. I'll continue moving the market. All right, so we move our risk down to this where we've entered. So we've covered that. No more risk on the deal. Okay, so let's talk about profit taking. Again, getting back to the concepts of fuel consumption and the volume profile, which is best thought of as agreement and non-agreement, where traders do and don't want to do business. In the profile, we've moved through an area of low agreement. See this here? All right, so as price came into this area, it's then just dropped straight through it because no one wants to do business there. But have a look where it's actually now sitting. This is an area where both buyers and sellers agree on doing business. So from our perspective as a seller, that means it's at a price level where buyers are likely to step in. Make sense? Now hold that thought. What else have we observed? Price has moved almost vertically downwards since we were filled, which over this time would have used up a lot of selling fuel in the short term. We've had multiple points of evidence to initially take the trade. Now we're seeing multiple points of evidence to exit the trade. There's also another point I'll make which we can't actually see, but you'll be able to see this when you go back to your live charts. Market pace. So I talked about the way that traders get trapped. Most of the things in the markets are counterintuitive. We've seen how when price moves really, really quickly, it's not due to a hell of a lot of volume. So I'm sure you've seen this, that when the market, the faster the price moves, the more quickly it's actually using up fuel. So think of someone going for a run versus a walk. If you run as flat out, as fast as you can, how far will you get before you need to stop and have a rest, have a breather? Versus someone who takes a walk. They're not going to, if you look at the person who goes for the sprint, the person going for the walk is going to obviously not get to the end of the sprint distance in the same time, but over the longer time, they'll actually go much, much further before they suddenly get fatigued and have to have a rest. And the market's no different, if you can think of that analogy. So based on the above, the current level becomes my exit. So here's an important point. I do not use set and forget profit targets. The market is a living, breathing, live auction, and so profit targets are based on real-time observation. All right, but that was just one trade, wasn't it? Which in the big scheme of things, it's not very meaningful. What is meaningful is being able to apply a robust trading approach, trade after trade after trade. So what does that look like? So this chart here, what you can see is a mixture of wins, losses and scratch trades, and notice how there are no home runs. There's no knockout punches, just singles and doubles and losing trades using tight risk management. So, trading, this is the daily practice of trading. Now, this is an important point, and this is something that I really learned and benefited from trading in a proprietary trading firm, where at the time we had the largest interest rate trader, individual trader for the Australian markets. All right, so I know for most of you, Australia, it's this little tiny little spot, but for someone to trade the most volume on one particular product that is heavily traded by institutions, that makes them a significant volume trader. So this is the point. That tight risk management is what enables you as a trader to beef up your size. So when you might have previously been risking, say, 15 pips or ticks, trading, let's say, 4 lots, for example, suddenly when you're using tighter risk management, that 5 ticks risk that's been reduced allows to beef up your size to 12 lots, and so on. So do the number of trades as shown above each day with increased size, not increased risk, and that's how the game's played. As an FYI, you might have seen in the notes that I trade live, run a live trading room. That's the actual trades from broadcast in the trading room, from one of the days in the trading room. All right. Fact. There is a large failure rate in this industry. So I just mentioned the live trading room. The live trading room addresses this by providing an environment for focusing on maximizing trader profitability and therefore putting the odds in your favor. That's a bit of a spelling mistake. It's AFSL, just means that it's under actually a licensed provider. And each day I do a daily prep session, look at a lot of the profiles, previous days, previous weeks, previous months, to determine where traders do and don't want to do business. Present real-time trade opportunities, real-time instruction on scaling in and out, and also provide viewers access to institutional tools, volume profile, the cumulative delta, footprint, etc., which if you're trading and having to subscribe and purchase all of those tools yourself, it's definitely a significant monthly outlay. All right, so I've had to move fairly promptly through everything that I've discussed today because trading can't be condensed into a 30-minute presentation. So to back up everything I've discussed and to give you the chance to see what I've covered today actually in practice and in real time, I'm offering everyone here today a 2-week trial to the live trading room. All right, and each week I take a scenario from the live room, typically relating to a trade that we've done, and create an educational piece to send out as a reinforcement of what attendees in the room are learning. I do this because these concepts that I've talked about are not accessible anywhere. You can't go and find this sort of information on YouTube and webinars and things like that that you can access freely. So in addition, by taking advantage of the 2-week trial means you'll receive these educational pieces which go into more detail than covered here today. All right, so the easy bit, to gain access, you simply send an email to me at thetradingpractice.com. So you just make a note of that address. And that is it for today because of time. Now, before I go into questions, there's something else I want to share with you. Most of us write little reminders to ourselves about our trading. You know, the little yellow notes, and we stick them on the screen, and then the sticky runs out and we put sticky tape on it and stick it on the monitor, and then on the edge of that monitor it's had like 3 or 4 years of sticky notes that builds up a residue. So that's the same. So this is actually my note, and I don't want to get too deep here, but one of the biggest challenges in trading, in a trading career, is actually having the support of your family, a partner, husband, wife, etc. So I know from speaking with other traders and my own circumstances that we tend to get into trading and overestimate how it's going to work out for us in the short term. And then what we do is we relay this to our supportive partner. And the reality is it doesn't tend to happen as quickly as we think it will. And then what happens is you start getting into friction, etc., with those who are supporting. So I can't emphasize enough about how family support, etc., is important. So the best thing, in my view, from experience, is to just recognize that it's a process that does develop over time, but not immediately. However, if you stick at it, it compounds, and it does pay off over the longer term, and significantly so. All right, so that was my little service to saving marriages and relationships. Okay, now let's see if I can go through some of these questions. My gosh, where do I start? How are we going for time, Juanita?
You're doing pretty good, Adam.
If you're
You have
there.
about 10 to 15 minutes.
Okay. All right, so I saw a question there about not understanding how price spiked on such low volume. All right, so actually I'll take it back to that. So if, in case some others had the same query, let me see if I can find that. All right, these spikes here on low volume. All right, so remember that price, there's something that I spoke about initially is think of all the buyers and sellers in the market right now and take a snapshot. All right, it's a limited amount, and suddenly a whole lot of people want to exit, and that whole lot of people, in this case, can't all get out here. So some get here, and then here, and then here. But this is an area where people don't want to go do business. So all of this volume that's done over, say, look at that period of, as an analogy, look at all that volume that's done in that little piece there. Spread that out, and that's what's happened. So this is traders exiting, accepting worse and worse prices because it's that imbalance between those who want to do business right now versus those who are prepared to take the other side. And that's what causes price movement. And if it's sellers, for example, once all the business is done and fuel's moved up, bang, that's why it spikes. I got a question about what are the values of my moving averages. Honestly, I do not use moving averages in the general sense. You can use whatever you like. They just happen to be the settings that I've used for like 15 years. I don't use them as in the typical sense. For me, they're actually just, they're like having if you're, rowing and you see the coach, I guess that's maybe not a good analogy because not everyone lives near a river where there's rowing taking place. But if you're playing a sport and you've got a coach on the sidelines who's yelling out instructions to you, the moving averages serve that purpose for me. They're a bit like, hey, Adam, do you know that the skew's going down? Oh, yeah, thanks for that. And also, when price moves away from them, I call this price expansion, it's a bit of a reminder for me to go, oh, price has moved away from the moving averages. by a certain amount, gee, a whole lot of fuel must have been used up. That's something I need to take into consideration. So they're just a 20 and a 50 EMA, that's it. But honestly, you could use whatever you like because I'm not using them in the kind of technical sense. So do I post to YouTube? No, that's why I suggest joining the live trading room, because that's even better because it's in real time, so you can actually see this stuff called out as the market's actually happening. What else have we got? Okay, I've got a question here. What instruments do I trade? This is actually a really good question. Now, I trade one instrument. Why do I do that? Because when you trade one instrument, have a think. Trading's best thought of as competing against other traders. Now, guess what? When I'm trading the Aussie dollar, the people that I'm trading against are generally the same group of people, because retail traders don't impact the market. They're this tiny little dot, you know, in terms of big trading. So you'll find that professional traders, institutional traders, they focus on one or two instruments. So you get to know the behavior of it because you're trading against the same people all the time. And I specifically trade during the Asian session and the early European session. And in particular, the beauty of the Asian session is that the traders are, how can I put this politely? They're, if you've got your absolute supreme athletes, to use that analogy, take a step below that, right, the next rung down, and that's the Asian session. So for me, I want to try to improve my chances of performance. So if I can lower the bar of the competition, that helps me enormously. Now, there's another trader who some of you may have heard of. His name's Don Miller. He's in the US time zone. He talks about the best opportunities being in actually the Asian and European session. It's just a fact. The trading is it's got less super talented traders in it who are trying to take your money, so it's less difficult. Got a question. Aren't most indicators just retail traps? Well, I don't use indicators. I basically watch what's happening with the market. As I said, we didn't discuss moving averages in terms of working through a trade. I don't use indicators. The volume profile changes over the course of the day. I pay a lot of attention to that because it tells me if buyers and sellers are agreeing to higher and higher prices. That's really good information to know. Or if they're offering it down. And if you see, if you come and sit in the room, what you'll see is the areas that we focus on based on previous auction results, which is a volume profile from days and weeks and months. It has a massive impact on how the market, where the market moves to and away from. What else have I got? So I've got a question. Asian markets are less liquid. The Aussie dollar is the 6th most liquid currency in the world. There is no issue with liquidity. However, there are price areas where traders don't want to do business. So what you want to be able to do is be aware of those areas and aware if traders are likely to get trapped, because when price moves into those price points, it moves very aggressively. You get the fastest, biggest payoff in the areas of where there's low agreement. So you actually, that's a big focus of what we do in the room. So while I focus on the Aussie dollar, I often hear people say, I'm focusing on this or I'm doing that. I'm like, is that the best for your trading? I would go where you can make the money. Like honestly, I couldn't care if it was the Aussie dollar or pork bellies, but that's too illiquid for me. It's all about finding the market that enables me to carve out a living. That's essentially what it comes down to. So the ES during the US time is a very congested market, full of big professional traders who are really good at taking your money. However, the principles that I talk about day in, day out, they're applicable to every market because all of them are options. So if you're after, so I've got some questions about educational pieces. Yes, if you sign up to the room, as I mentioned, yes, that's fine. You'll receive that. I do trade into the evening of the European session, so the room's open for like a long part of the day because I do spread my trading out over a long period. So I actually do have US and Canadian attendees during the day, so you will see some overlap. Now I'm getting a message here, I think, from Juanita, which is probably to say, hey, we've run out of time. Is that correct? Is that correct, Juanita? Yeah, so we're just coming into the end of the session. So again, I'd just like to say thank you to everyone for coming in. There's no risk to step in the room. There's one thing to sit and chat passively when there's no market open. It's a completely different experience to watch and see someone commentate as they're actually entering and managing trades real time, and that's got to be beneficial for anyone to see that and how it plays out, and how, most importantly, as a
Okay,
retail trader, which
Adam, I just wanted
I'm then now. Yeah.
Sorry, the mic might have went out there and I thought you were done. Go ahead and finish. I could wait a moment.
Okay, yeah, so look, thank you to everyone for coming. Please feel free to send me an email to come into the room. That's the opportunity to see someone trade live day in, day out, and share those trades with everyone you may as well take advantage of it. And thanks again for attending. All right, Juanita, over to you.
Thank you. I want to give a special thank you again to Adam of the Trading Practice for a great presentation today. Everyone in attendance here will receive an on-demand recording of today's event. Please keep an eye out for the email that will be coming through. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope that you do attend them on a regular basis. You can find the upcoming webinars and archived webinars using the following link. We'd like to remind you the information provided in this was that of the trading practice and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spend with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at NinjaTrader Ecosystem. Thank you again, Adam, and have a wonderful afternoon, everyone.